Well, first I'll start off by saying, though, Eric has brought that the new tax deal to IvyFON many times before. And I try to introduce them to some people. None of those people wound up becoming investors. This was before I was in the investment banking business. And I really think that's a fantastic company. I think it's got great upside, but as he said, it's asymmetrical. So it's an interesting deal. But it's got some risk attached to it too, right? That's why you get the upside if it succeeds. But anyway, we're here to talk about mergers and acquisitions, and I've got a great panel here this afternoon to talk to you about this. Just to shed some more lights on these topics. Chris Angie is on the video over there. So
hi guys, how are you?
Dapper as usual. Alejandro is right over here. He's with ATX Invest, and Milton
Barbarash.
Thank you. I appreciate the help here. He's with Empire Global Advisory Services. So we have three brokers on the panel, a moderator who's an investment banker, a broker as well. So we're looking forward to having this conversation on mergers and acquisitions. I will be moderating this. My name is Mark Heil. I'm with a group called Pickwick Capital Partners. We are FINRA registered. We work for both companies and funds in raising capital and also executing mergers and acquisitions. We're pretty agnostic when it comes to industry. We do have some sectors we specialize in. Just to give you an idea of how agnostic, here are some of the deals I'm working on. We got a real estate self-storage company that we're helping to raise capital for. We're working with a developer that's active in Florida, Texas, and Illinois. I'm working on a farm deal in the middle of the United States where they're aggregating farms. That's a very interesting play. A startup football league I'm working on. So that's another interesting one. It's got some very unique ideas. And an hour from now, we'll talk about sports. So I'll be back up here. You're going to hear all this all over again. I've got a tire recycling company doing some very interesting things and breaking down the tires. And that's a huge problem within the United States today. And then finally, we got an interesting coatings company that can be set in wet environments. So think about underwater operations, things along those lines, and even inside the human body, there's some applications for it there in terms of fixing bones, veneer on teeth, things of that nature. That just give you a little insight of the types of things I'm working on. For the next hour or so, we're going to be engaged in a conversation about mergers and acquisitions, and you're invited to the party. You have a thought, you have an idea, you have a question, feel free to just chime in, make it known to us. We'd love to respond to it. The only thing I'll ask you is, we don't need a speech, we just need a question. So try to be short and to the point, right? Finally, the one thing that I'm known for more than anything, and people were asking me yesterday, are you going to do the disclaimer? Of course I am. Information presented for educational purposes only and is not intended as, may not be relied upon as tax, legal, investment, or other advice. To the extent myself or one of the panelists expresses an opinion, it's our opinion alone, not necessarily the opinions of our firms. So with all that out of the way, let's get into the introduction. Alejandro, why don't you kick it off and give us a few minutes, give us a few minutes from your background and your company.
Sure, thank you, Mark, and thank you, Marty, for the invitation. It's an honor to be here. My name is Alejandro Schrecken, and I've been doing M&A pretty much all my professional career, starting out work at the World Bank and in Mexico and in the US, including private equity. And I've been doing M&A as in a role as a principal investor, as advisor on the buy side, advisor on the sell side, capital raising. So over the years, you accumulate a number of different experiences in different sectors and different situations. Right now, we are advising groups in raising capital for industrial land development on the border between Mexico and Arizona. That has a component for electricity and data centers. We're working with a company that is doing, through acquisitions, roll up of veterinary clinics. We're working with the family office trying to monetize some of their assets. So different things, and as I said, much of my experience has been in Latin America and the rest of it in Europe.
Fantastic. Thank you, Alejandro. Milton, would you do us the favor and tell us a few words about yourself as well as the Empire Global Advisory Services?
Sure, my pleasure. Thanks again, Marty, for the invitation. Thanks everyone for attending. Real quickly, my background started with KPMG as a CPA, got my license and did a MBA. Then I worked with EY and their mergers and acquisitions and valuations group. After that, I was there quite a few years. I was hired away by coincidence. I didn't know. I worked for RBC. I ran their mergers and acquisitions group out of Toronto, out of their head office. Did that for about 4 years, and then one of my billionaire clients bought a group of companies here in Boca Raton, and I relocated here in the mid-'80s. It was a turnaround. I tell people, since there's a number of people here physically, I got here, I was about 6'1" and had jet black hair, and basically took over a turnaround, became CEO of a 400-person New York Stock Exchange member securities firm and a real estate development and brokerage business. We took it from losing about $600,000 a month. We sold it in the early 90s for about $150 million. I tell people in the early 90s, that was a lot of money. Today, everything has to be a unicorn or $1 billion, or you haven't really moved the needle. So after that, I stayed on and set up my own firm. I stayed on as a consultant, but set up my own family office, principally because of my background. We're looking to buy businesses, and I have other families that co-invest with me. I typically find the deals. We also do a little commercial real estate with that. But we run a full active mergers and acquisitions team. We're part of the Empire Broker Network. We have 80 offices across the country. Separately, we have 2 international investment banking partnerships, so we can do deals anywhere in the world. We still own a CPA firm and business valuation firm. I still have all my licenses as both, but most of that work is done out of a 150-person firm based out of New York. So we have a full suite of services from audit to tax, et cetera. And then we raise money for companies. I have a partner who's part of a broker dealer, and we can talk. And we raise money for companies and fund managers. In terms of deals, we're pretty eclectic. I tell people that I could pretty much talk to you or talk with an expert in almost any industry you can imagine. I'm not an expert, but in those industries, but I know enough to talk to an expert. So in other words, from my valuation work, from my CPA work, from my M&A work, from my principal investing, I see a pretty broad spectrum. And this type of conference is really helpful for me because I always like to hear. I'm a big macro guy. I did my MBA in international economics and finance. So I'm sort of an armchair economist. And I love to hear what people's takes are about where the economy is going, both domestically and globally. So we'll be looking for the feedback on the M&A side. I have some specific thoughts, so we'll jump into.
That sounds great. And it's good to have a rookie on board.
Yeah, just starting.
Just starting, right. Chris, why don't you wind up the panel here and give your background, talk a little bit about what you do.
Sure, and I'll be relatively brief so we can get to the M&A piece. I've spent 30 plus years in financial services, started off at a bank building 40 Act mutual funds, then I ran my own broker dealer for about 15 years. And since 2015, I was wearing 2 hats. I'm running a broker dealer that is a quasi investment bank, similar to Milton. We raise money for basically Series A Series A clients. We've had some pretty good, we've got excellent deal flow, to be candid. And we have a group of ultra high net worth individuals and a couple of family offices that we that we put together. Sometimes we put together SPVs or we'll go direct. I'm currently working on a phenomenal prop tech offering. It's a great software for commercial real estate owners. It's a data aggregator on the buildings that leads to insurance services and dramatically decreases costs across the board. Phenomenal company. We've got some really good interest. So if anybody's in the commercial real estate space or prop tech space, let me know. And then I also have an up and coming non-alcoholic beer brand, currently doing about 10 million run rate this year. That space is the only bright spot in beverage in 2024. And then for the last 8 years, I was COO of a family office for a New York City real estate firm. That office closed down due to a death in the family. Currently looking for another COO role in a family office. So if anybody out there is looking, let me know. And that's basically where we are. So off to mergers and acquisitions.
Fantastic. Thank you all for your backgrounds, and let's dive into it. Mergers and acquisitions in 2021, as we all know, was a fantastic year. It set records for the numbers of deals, the amount of value raised, and then 2 years later, it all came crashing down in 2023. 2024 was slowed by election uncertainty about where the economy was going, what was going to happen, what was the future going to look like. That is now behind us, only by a few weeks, but it's still in the rearview mirror at this point as to who's going to be in. Now the question is really, what's it going to look like when he gets in and what happens? E&Y has, taken the brave dive and projected out for 2025, and they project a 13% increase in deals and value. So my question to my panelists is very simple. Do you agree with them, disagree with them, think they're optimistic, pessimistic, or they're about right?
Want me to start?
Yeah, sure, Milton.
Well, when EY is doing a projection of 13% increase, part of that, I don't know if it's number of deals.
It's both, they're saying both.
Both, okay, because size of deals, one of the reasons that people are more optimistic now about mergers and acquisitions with the new administration is they believe there'll be less regulation in terms of antitrust. So size of deals, the big investment banks are gearing up, I'm sure, hoping to be able to get through deals that they were like, well, I don't know if we'll be able to get that one through. Now I think they're going to give it a shot, or at least once they get a feel for who's in the antitrust division to see what their flavor is. So I don't think they know yet. I could tell you on number of deals, if you go on our website, we have right now, I just checked it, there's a little over 2,200 companies we have listed for sale. And you can go on that site, there's no charge. But we've had peaks where there's 4,300 companies listed for sale. And that's updated by 1,000 brokers, just to give you an idea. So that tells me there really hasn't been any movement immediately. So all of a sudden it's like the press is writing, M&A is going crazy, it's increasing. I mean, why? Like really nothing has changed yet. And it will take time to change. So could it increase? I think just the optimism may help to increase it. But one of the concerns that I would have is, along with that optimism, sellers become more optimistic. And what happens when sellers become more optimistic, what do they want? Higher prices. When they want higher prices, it's tougher to close deals. So I think the number may work because of antitrust and big deals. Number of transactions, not sure yet.
Okay. Chris, how about your experience?
Well, look, not to reiterate the obvious, but we all know that 2024 was what I call was a logjam, especially in my part of the market, which is we like Series A, Series B companies because we think that's a good valuation point. They can grow to a certain level. And then when they decide to sell, there's numerous players that can purchase them at that price. When you're talking about the larger deals, obviously the pyramid gets smaller at the top, and getting those bigger deals, there's only so many people that can actually buy it. So we've definitely seen a log jam in the middle market or lower middle market deals. And as some of my investors have said to me, they're like, I'm marking all my stuff at zero because I've been in this one 6 years, or this one 4 years, or this one 3 years. So we're waiting. To Milton's point, we're still waiting. I do think getting the election out of the way, I think you do need the cost of financing to settle in. While you're in an interest rate cycle, the Fed's been a little bit wishy-washy. We're not really sure what they're trying to do. While everybody's expecting more rate cuts to come, courtesy of the massive debt load in the United States, they're going to have to come down because the interest expense is going to be punitive, for the country's budget. So I think we still are a few months away from everything settling in to find out what the lay of the land is. But I will say that there is real pent up demand on the sell side because people are really looking for the liquidity event, and that comes back to Milton's point: is what is the price? Because as we all know, the highest attained is the least expected. So if the company was worth, $700 million in 2022, and now they're going to do a buyout for 580 or 620, people psychologically don't think that's a win. So maybe principals are going to try to wait out and try to see if they can hit that high watermark or not, or they'll just hit the bid when the time comes because they need to exit and get their people some liquidity. And then lastly, on this point, I do think that for investors in this space, once the log jam breaks, they get some liquidity events going, then people can start putting money back to work. I think then the wheel starts turning again, and we could be in a pretty decent cycle.
Yeah, and I think that logjam is pretty real, to be fair with you. Bain threw out the numbers of 3.2 trillion for unrealized value in 28,000 unsold companies. So that gives you an idea of the backlog that Chris was talking about. And my question to Chris and the other panelists can feel to chime in too is, how are these companies surviving right now?
Well, they're not. I mean, I was tangentially involved with a company that was inside one of these funds that we know, and it was a rock star, great valuation, and they sent out a capital call letter to their investors, and they were like, oh, hey, look, we need to do a bridge. And everybody's like, sell the damn thing. And then it turned out that they couldn't get financing for the bridge. They couldn't figure it out, and now it's getting liquidated for the IP. So to your point, I think we're getting very close to where companies are going to have to figure it out. They're going to have to really, because they're out of options. And doing a Series E or a Series F with prefs and stuff like that, the existing investor base is patience is gone. We definitely need this to break.
Yeah, I think you heard the example of Neotex from Eric a little bit before our panel began, talking about how they did a $17 round share, $17 million round share a couple of years ago, and this year they had to do a $5 million round share to save the company. I think that's becoming more and more common as we see this getting thawed out and worked through. And the fairness is that's not going to be resolved in a day. That's going to take time, and it's going to take a certain amount of throughput, and all these companies have to figure that out. I guess what I want to do here is just shift more a little bit to the M&A side here. And I'm going to come to you, Alejandro, and maybe you could talk about what are the key steps for running the process for a company that's selling.
Well, that's always a big question because as a professional in the M&A field, we do several transactions a year or more. And if you do that over a long period of time, it sort of becomes natural to work in this kind of deals. But for, say, a family-owned business that wants to sell their business, it's the first and maybe only occasion in their lives as investors and business people where they go through that process. So very often it requires quite a bit of education, hand-holding, and that's where you really can contribute quite a bit of value And we give a lot of importance to the combination of the financial aspects of the transaction and the strategic aspects of the transaction. They have to go hand in hand. Sometimes people think, well, it's very easy because somebody sell the company and that's it. No, it's not that easy. You need to find the kind of interested parties that have a reason to be in that sector, who are prepared to pay a premium. You have to get involved in discussions about what is expected of the current owners and shareholders as part of the handover. So it's quite a lengthy process, which can take half a year or longer. And quite frankly, it's an enjoyable part of our work.
It is. It requires a lot of collection of documents and information on the upfront. And sometimes clients aren't thrilled by that, but that's the reality of what has to happen. But let me just flip over to you for a second, Milton, if I could. In terms of, setting expectations, level setting the expectations of a client in terms of timing, market conditions, speed of transactions and all that, how do you approach that with a client that's going through this due diligence process and then you're starting the process for?
Some form of volume is a good way to start. The client remembers a transaction that happened 5 years ago where somebody they knew a guy who sold his company for some outrageous number that they think theirs is worth more of. So, the concept of, hey, the market is going to dictate what your company is worth. One of the things that I typically will do, which I don't think a lot of people will understand when you first come to them as a new seller of a business, is what I'll do is I'll walk them through the other side of a transaction. What I mean by that is, what is this going to look like for a buyer? So if I'm the buyer, and people talk in terms of multiples, right? So an EBITDA multiple, everybody here knows what an EBITDA is, I'm sure. So when you talk about an EBITDA multiple, they want 5 times, 7 times, 10 times. So you say, that's great. Let's say you think you're worth 10 times EBITDA for your company that does 1 million a year in EBITDA. You want a 10 times multiple. What does that mean to the buyer? That means the buyer is going to have to wait without a return on their money 10 years if you keep that same $1 million of EBITDA to get their money back. Okay, so they didn't get a return on their money and they have to wait 10 years and hope that our numbers don't go down. So I walk through that process, and at least doesn't mean they're going to change their idea on valuation, but they start, they start to understand there's another side to this. Because if it doesn't make sense to a buyer, they're not going to buy the company. So unless you have something unusual, or unless you have a high growth, it's different if you're doing $1 million and next year you're going to do 2 million and the year after you're forecast to 4 million and you have a backlog of business, you're high growth. Okay, let's run those numbers. So I try to show them what does it look like on the other side, just like any negotiating where you are, all the negotiating courses will always tell you, try to think of what the other party really wants. And most sellers are not thinking that way. They're thinking about what they want. And I try to get them into a world of reason. That doesn't mean it works. I don't want you to think like I'm a master and they agree right away. They walk away thinking, I must not know what I'm talking about. And, it takes time, much along what you said. The sale process can take 6 months, 12 months, depending. The more realistic they are on valuation, often the longer the deal's going to take too, in terms of timing. And if you don't mind, I'd like to go back to one of your earlier questions. Okay, when we're talking about why deals aren't happening. Okay, why is there this private equity backlog? Today's Wall Street Journal, last page, had an article on it for anybody who reads the journal, talking about now there are funds that are lending against NAVs. They're lending against, net asset value of the funds to try to get them some liquidity to get back to investors, because the investors are losing their minds that they've been in these things for 5, 6, 7 years. Why is that? One, there's a type IPO market. Two, banks are not lending. There's a reason that there's this huge growth of alternative asset managers, alternative asset sources, which is now outpacing banks in terms of assets under management. So the typical banks are not lending to the average buyer to buy the companies that these private equity firms want to sell. And the other thing is, the longer the private equity firm holds that asset, what happens? These guys are looking for, or girls, whatever, these teams are looking for, on average, they like to get 25, 30, 35% returns, right? Well, guess what? If you hold it for another year, you need a higher price. If the market does not command that higher price, you're stuck. So it's not so much money raising. They don't need money raising unless it's for working capital, for expansion. A lot of these are good companies. I'm not talking about startups and losing companies. I'm talking about good profit generating companies. They can't get an exit because they can't get the price they need to show their investors for their next fund that they did the rates of return that they promised them when they put the money in. So just
absolutely.
just a
And
little
it
more. I wanted to
all-
fill that in from earlier.
And if you think about it from the company side, is they have multiple investors in them, right? Some of these are gonna be high net worth individuals, some of these are gonna be institutional investors, some of them are gonna be family offices. And they all have different time horizons they like to work on, and they all have different needs, right? So all that factors into when a sale gets completed and when a sale process can even start. So I think they're all very important things. Chris, I want to shift over to you for a second. And, as you're going through your process and as you're getting clients ready, are there red flags that you look for in terms of that would cause you to walk away from an opportunity?
Oh, of course. I mean, we walk away. We've been doing this a long time, so a lot of it comes down to instinct. And when I was at the family office and we were doing non-correlating investments, I had three buckets of investments. One is thematic investing, where you're going to go out there and you're going to buy stuff on your own personal shopping list. Let's say you're interested in data center supply chain companies. So you're going to look for different kind of stuff that support that industry. You're going to go proactively look for that. The second is deck roulette, where you're just, you got a shingle out that says that you have money to invest. You're just going to get sent a lot of inbound. You have to give them their due because God forbid there's a 10X in there, but your gut can pretty much do it. And then the third thing that we look for is what can we invest in today that's on private equity's shopping list 3 years from now or 4 years from now. Now, obviously, we never invested in veterinarians because who knew that private equity was going to go roll up veterinarians all over the place? Because I'm in New York City, there seems to be some branded veterinarian place on every other block. But to your point, we try to handicap where we believe the market. Look, it's always about where the puck is going. It's not where the puck is. And so that's why, for instance, we like this non-alcoholic beer brand because it's in a good price point and it's in a growing space. And for those of us with a little bit of gray hair, the 20-somethings are not us. They're not going out at the same rate we did with the same sort of broker dinners and all that kind of stuff. It's a different world. And then you have an older demographic. So we try to look at our deals like that. So there's definitely some things that we just won't look at for a variety of macro reasons. And then if there is something that we like, and then we begin the due diligence, then we'll look for the usual issues there. And that usually boils down to, at least in the space where we travel, is management's ability to execute. Are they serious? Are they able to get things done? Do they have a track record for getting things done? Because one of the big problems that we've had in two previous investments was what we coined is founderitis. And founderitis is when the founder is way too close to their company, that they just won't let go. They're not moving it in the right direction. And as we all know, there takes a lot of genius to be Michael Dell or Sam Walton. If you got, at some point, you got to let go of the reins and let the administrators and the MBAs come in and grow and build your company. So we do find that people that have a penchant for founderitis to be a little bit of a red flag for us.
Yeah, I think that's a big one. And, on that theme, we had a fund manager in early this year, raising a small fund, but with a great strategy. And we were engaged with them for, capital raising, where this was obviously not going to be an institutional raise. It was going to be from high net worths and from family offices. And as we were going through that diligence phase, we were asking for documents, reviewing them, and just talking to him. This guy was so arrogant. I just said, I'm not putting him in front of any investors. This guy has a lawsuit in 2 years. That's a red flag, not the kind of person I want to be around. So Alejandro, I want to come over to you because Milton touched on it a little bit earlier when he was talking about banks and the debt markets. What are you finding right now for deals? Particularly, I think you mentioned you had a roll-up deal. So what are you finding the debt's available for these types of plays and when you need it, and how easy it is to get? And, maybe you can give a little insight on that.
Sure. There is institutional money around interested in roll-ups. They have been quite numerous and successful in the US. And this is something that's being copied elsewhere. There is one that we're looking at right now. They have copied what has been done with veterinary clinics in the US, in Spain. Not a very large scale, but it's been quite successful, and they were able to raise capital for that. And we're now doing around in Mexico, and it looks like this is a quite attractive market. Mexicans spend even more than Americans on their pets in the system, and it's a good market to roll up, particularly since clinic founders eventually are going to look for an exit. Not everybody has a generational successor in the family, and it's like doctors' offices as well in some professional businesses where the succession question is significant. Some of these businesses are quite substantial. They have built a practice into a small hospital or a specialized clinic. And so somebody who comes in with the expertise of doing cookie cutter acquisitions, having administrative systems in place to help them become more efficient and have a plan where they keep them on for quite a substantial time with a significant earnout. That kind of a transaction is attracting interest from funds.
Yeah, and I would agree. We're currently we're involved in the defense industry. We're doing a roll-up of these veterans who we got to know and are very good businessmen are rolling up some companies, wanting to keep them in the hands of US investors, right? Not seeing them go overseas where a lot of foreign interests are interested in buying the supply chains that lead up to the Lockheeds of the world, right? And the debt market has responded tremendously to it. Come from all different sources. It could be asset leasing companies. It could be, just independent debt funds that are looking for returns. It's really been the easier part of the process rather than the more challenging part of the process, finding the debt to go into these deals as they roll them up. So, and a lot of these are mom and pops, right? When you think about the supply chain, the very bottom of the supply chain, it's a lot of moms and pops. So, one of their acquisitions they did was this company didn't have a sales force for the last 20 years and was running off Windows XP, right? So they stepped in, immediately took over that company, and immediately increased sales just because there was low-hanging fruit to be had by getting in there and making some connections for them. So those are fantastic.
We call them mom and pop shops because of the way they were created in many occasions. but some command eye-popping valuations.
Sure.
And we're talking about the range of $10 to $20 million once they have grown to the size of a decent clinic. So they may have started as mom and pops, but many of them are significant businesses.
Yeah, and in fairness to this company, the owner of the company's owned it for 40, 50 years. This family has owned it. And their only real interest was keeping all the employees employed. So they weren't really focused on trying to grow this. It was just there. It was a nice business. It cash flowed to them. So they were happy just having it run the way it was. But it wasn't really being run the way a business could be. And that's what the opportunity is now for them. Milton, I want to switch over to you. I want to talk to you about, when you come across these opportunities, such as the ones, I was talking about a minute ago, or perhaps one Alejandro was talking about. How do you assess the moat that's around the businesses? What is the moat? What gives somebody a deep, strong, deep moat? And how do you assess that? How do you evaluate that?
Well, we get approached by a lot of companies. Let's separate between financing, like companies looking for financing versus ones looking to sell. The ones looking to sell, hopefully, because we usually only take them, except in rare instances that they already have profitability. So they've established some sort of level of a moat, whether it's they have a captive customer base, or if they have some technology that's proprietary, or techniques that are proprietary, or they may be a geographic region that they're covering for their particular product or service. So there's usually something, hopefully, that we can see that's it may not be totally unique. In other words, you could have a franchise, like we sold a franchise of the Fast Fix jewelry repairs. You probably see them today in all the malls. It was a franchisor. He had at the time about 25 franchisees, but there was tons of ability to grow, and there really wasn't a competitor. And we sold it to actually a private equity fund bought it, and they rolled it up. So you try to. They may be small. Sometimes they are in the right area. Now, on the other side, you could have, not that we've done a lot of these, but you could have, let's say, we did a chain of Popeyes. They had like 25 Popeyes. So it's not unique, but it had a geographic footprint. So somebody else wants to buy that franchisor who owns all those franchisees. So if you're making money, there's usually something you're doing right. And then we have to just play up on that to try to find the right strategic buyers who would, basically want to take advantage of that and hopefully expand it.
Fantastic. Well, Marty is sat down over here, so that means the long cane is out. Chris, I'm going to come to you for the last question. So the last question I'm going to ask you is, if you were put on your family office hat, if you would, go back a few years, put that on, and but apply to today's market, where would you be looking for merger and acquisition deals if you were a family office?
I think that there's going to be, I've historically liked consumer. So I think that there's a lot of consumer brands that are ready to go. They've been growing pretty well, specifically in the cosmetic space. I know of a couple off the top of my head that, because what happens, in the consumer space, you get these companies, and it goes back to this full circle thing about credit, private credit, how much you have to, they can only grow so much given either by cash flow or however they're growing. So there is a lot of evergreen marketplace for somebody who has the ability to bring these companies into full distribution. So that's another reason why, not that I'm talking my own book, but I am. That's another reason why we like this non-alcoholic beer, because we believe that they're growing at a good pace in which their balance sheet can support at this particular point. But there's a level at which they can grow, and then some player can come in, throw them on a Cisco truck and put them into full distribution. And the amount of growth that they can get out of that is amazing. And we have seen that in other forms of the consumer space. The other thing I do like the data center business. I think that there may be some consolidation there in the data center side, given the massive amount of growth that's going on there. So that's a couple of the different areas that I would think. And then there may be, look, the tech space is the tech space, and they typically can find their marriage partners. And this is all, vis-a-vis mergers and acquisitions, obviously, what I think is coming down the pipe. But with that said, I do think we're going to see widespread consolidation and deals done across a lot of different things because a lot of these companies are tapped out. They're ready to go. To Milton's point about family-owned companies, I think a lot of the as generations get older, the kids don't want to run the family businesses as old as time. So a lot of those businesses are ready to hit the bid. Like I said earlier, the highest attained, so is the least expected. So 5 years ago, the family business was worth 80, 90 million. Now it's worth 50, 60. The kids are going to wait for 80, 90 again. Maybe they'll get it with a few rate cuts or not, but I think that's where you'll see some movement.
Well, fantastic. My name is Mark Kyle. I thank you all for listening to us and being here this afternoon. Great job, Alejandro, Milton, and Chris. Really appreciate the insights and comments you provided.
Thank you, Mark. I appreciate it.